What's up, YouTube? This is Alex FS. Welcome to my channel once again. So today we have a special topic. Talks about breakout strategy. Okay, let's go. Breakout trading can be summarized as getting in once the market starts moving and getting out when it stops. Why simplicity? This is the epitome of success trading. You cannot make money when the market doesn't move, and then the best place to get it right as you start. Yes, trading seems to have the bad names. Now, this popular writer like A.I. Brooks continue to teach that most breakouts fail. So it's a bad idea to trade them. Wait for a pullback, they says. The problem is that many strong trends don't have pullbacks or have pullbacks that are late, often lesser profits can drive a day. Trader mad waiting for a pullback in a strong trend that never happens. Why this price skyrockets? It isn't logical to identify a trend start and not enter waiting for a specific chart pattern to form that may never materialize. The trend on long-term charts and short-term charts look the same. They are both tradable, but you don't need to trade long-term time frame to be a breakout trader. In fact, the difference is that a day trader has many more opportunity. A long-term time frame trader may catch a trend, may perhaps only one or two times in a day. Trader may get an opportunity several times a week. In fact, jumping on a strong new trend at the start is the easiest way to make money in the market. So the question isn't if one should enter a trend. The question is how and when the book provides you with the best strategy for doing so. Understanding market modalities. By far, the most important skill you can develop as a trader is understanding the market modality. This refers to be able to recognize whether or not the market is trending. If it is, there's a lot of opportunity. Don't say, I know all that. The truth that most traders know that yes, 90% lose money constantly. Sorry, consistently. Why? Because they don't have a well-defined method of time the market modality and stick to it. Consider the following. Look at this chart above and see this was a breakout. After a lot of ranges, market breakouts. Okay, chart one, ranging break into trend. Okay. For some time, the market has moved within two well-defined price points. The price has oscillated between the spots at the bottom and resistance at the top. When the price moves this way, the market is not trending. It is a range. After some time, the price broke strongly through the support, and a trend has begun. Notice the red bearish bar that strongly broke the, the range rectangle. It has closed out of the box and has a size larger than any previous bar in the chart. Okay, it's a strong bar in the chart. Let's go on. Now consider this situation. Range bloody range. So it's a range bloody range. Can't trade this. Where is the trend? Where is the breakout? There isn't one. The price is still moving within the two boundaries. There may be a trend on a higher time frame, but that's another matter that we consider later. Your job as a breakout trader is to get in once the range is broken and a trend begins when the market still ranging as in chart 2. Your job is to wait because trend begin as breakouts of the range. Breakouts. The first key to master is to identify market modality. In this market trend, if not, where where is the range? In other words, between which 2 points has the price been? Easily to do that by drawing a price rectangle. The top and the bottom should be touching one or several points. Put that on the chart. You trend. The rectangle will serve as a primary reference point of the breakout. Okay, let's go into the entry. We enter on the close of a strong bar that has closed outside of a recent price range, outside the price rectangle. What look for before you enter a trend? A well-defined range. Oh, a well-defined range, a strong breakout bar that closes outside of the range. The entry bar should be bigger than the bar in the range, but not climatic and have a strong close. All these entry criteria are important, but the most crucial one is three. The breakout of the range must be clear and convincing. The bar should be bigger than the previous bar, but not climatic. The bar should not be disappropriately big. Let's look at some examples. Look at this one. Let's see. Look at the bar. Entry 3 on bar 1. In chart 3, the entry happens on close of bar 1. The rectangle indicates the recent price range. Bar 1 has a strong broken out of the range and closed outside. Notice that the bar has a large body than any of the bar in the range. That is, it has a tiny wick at the bottom, indicating strong selling. Pressure into the bar close. Also notice that we don't care what market or time frame this is. You find this pattern across all instruments in all time frame. Okay, entry on bar 2 close. In this case, bar 1 close outside but simply wasn't strong enough, so we enter on the close of bar 2 on bar 2, which is convincing. Breakout bar. Again, notice the strong close size of the bar in this case, no wick at the bottom of the bar. Indicates very strong selling pressure. It was so far so good. You define your range and then enter on the close of the bar closing outside of it. Now consider the following chart. Okay, entry 5. Chart 5 has a defined range, but one break out of the range and closes high is it is a good entry? No, isn't. No, isn't. There is a difference between a trend and a spike, but 1 and 5 is a spike, not a trend. 1 and 5 is a trend, not a trend. It's a sharp market move too far too fast, typically with a poor entry for you. If you bought the close of the bar, one you would be buying too far outside the range, but one is it disappropriate big relative to previous bar. Don't enter. Let's look at one more cases. Okay, entry on bar 1 in this chart is a bar 1, a good entry. No, isn't. That because the price is extremely close to the range, right at the border. Advantage. The greatest advantage is that you get in at the start of a trend. This means you are entering a great price and can hold your position for large profit. Disadvantage. The greatest disadvantage is that you will sometimes enter as a breakout that will not develop into a trend, false breakout or fake out. Consider the following charts. Fake out. In chart 7, the rectangle defines the range. Bar 1 is a breakout bar, but after the entry, the trend was has no follow through and fell back into the range. Sometimes this may happen. There are no perfect setup that works 100% of time. In this case, you should have noticed that bar 1 did not have a large body than any of the bar in in the range, which might go like this now, which might have one because that the setup is not good. When you look at the chart, you have the breakers to be dominant and the range look prominent. In this case, the range looks vast and the breakers is minuscule. The setup is like work in all details. So this led us as to a very important question: why do we exit stop loss? So how do we know when the trade hasn't worked out? Clearly, the trade isn't working if the price has reverted back into the range. Typically, strong trend will never return to range from which they start. Sometimes the market will test the range and even penetrate it if a week tick before it take off. So your stop should be inside the range as the inside the range at least a few tick. I recommend at the stop 10 to 15 inside the range. This will not be shaken out easily but will taken out when it's clear the trend has failed. As example, consider the following chart. Stop loss entry. Stop placements. In chart 8, we consider on the close of bar 1 as the price breakout and closes strongly outside the range. We place the stop 10 to 15% inside the range, considering the point that we show how trend hasn't worked out. Take profits. The most important problem in trading is where do we take profits? Good trend may have large move, typically large than most traders imagine or anticipate. If your stop loss is 1 unit, more bigger than more one should bigger. How big should your profit? When you catch a great trend, you want to pay more. Whatever is you are risking. If you are risking 1 unit, I suggest that you minimum take profit points should be 2 units. If you are risking 15 ticks, you take profit points should be 30 ticks and away from entry and so on. So considering the previous charts, we should have the following our stop loss entry, take profit. Okay, take profit points at twice the distance from stop. We How will this work out in practice? Suppose that your profits are twice as big as your losses. That's you will only 50% of your trade. Here is the result of a equity simulation using those parameters, running 1000 trials starting with equity 100. Okay, okay. Hello guys, I hope you guys understand. So you have come to the end of the video. Okay, please subscribe and share. Also comment on the video. Thank you.